In an age where financial uncertainty often feels like the only certainty, the concept of an emergency fund isn't just wise, it's essential. Imagine a safety net that catches you the moment life throws unforeseen challenges your way. This isn't just a comforting thought, it's a strategic financial tool that can mean the difference between staying afloat and sinking under the weight of unplanned expenses. Whether it's a sudden job loss, unexpected medical bills, or urgent home repairs, having an emergency fund offers more than just financial relief. It provides peace of mind and stability in an otherwise chaotic situation. An emergency fund serves multiple roles in personal finance, primarily acting as a buffer that shields you from the immediate financial impact of unexpected expenses. This fund is instrumental in preventing the cycle of debt that often begins with unplanned financial shortages. By having a designated savings buffer, you can avoid high-interest debt options such as credit cards or loans, which can exacerbate financial strain. The presence of this fund also reduces stress and anxiety associated with financial uncertainties, allowing you to make better decisions during crises. Moreover, an emergency fund contributes to overall financial stability. It ensures that despite the ups and downs of life, your financial goals and plans remain on track. This stability is crucial not only for individual peace of mind, but also for the well-being of families and dependents relying on this financial predictability. To effectively build an emergency fund, you first need to understand and assess your financial vulnerability. This means looking at areas in your life where financial strains are most likely to occur. These can include job security, health issues, family obligations, or property maintenance. Conducting a personal financial audit helps in identifying these vulnerabilities. For example, if you are in a job sector known for volatility, your emergency fund should ideally be larger to compensate for potential job loss or unexpected career shifts. Understanding these risks allows you to tailor your emergency fund to your specific needs, ensuring it provides adequate cover in areas where you are most vulnerable. This personalized approach not only makes your emergency fund more effective, but also ensures that it is a reliable resource during times of need. Determining the size of your emergency fund is a crucial decision that should be tailored to your unique financial situation. The general rule of thumb suggests saving 3 to 6 months' worth of living expenses. However, several factors can influence this amount. Job stability. If your job is unstable or if you're self-employed, consider saving towards the higher end of the spectrum. Family responsibilities. Single earners or those with dependents might need a larger fund to cover everyone's needs. Lifestyle and monthly expenses. Higher monthly expenses necessitate a bigger emergency fund to cover all costs adequately. To calculate your ideal fund size, start by totaling your essential monthly expenses including rent, utilities, groceries, and any regular payments you must meet without fail. This figure multiplied by the number of months you want to cover will give you a target amount for your emergency fund. Setting realistic financial goals is essential when planning your emergency fund. It's important to set achievable targets to avoid feeling overwhelmed. Start by setting small, incremental goals. For example, aim to save $500, then $1,000, and gradually increase your target as you reach each milestone. These goals should be specific, measurable, achievable, relevant, and time-bound, or SMART. For instance, instead of vaguely deciding to save more money, set a precise goal to save $200 every month for the next 5 months towards my emergency fund. By setting realistic and clear goals, you can maintain motivation and see tangible progress towards building your financial safety net. Crafting a detailed savings plan is your next step. This plan involves evaluating your current income and expenses to determine how much you can realistically save each month. Start by listing all sources of income and every expense, no matter how small. Identify areas where you can cut back. Maybe it's dining out less frequently, skipping expensive coffee runs, or canceling unused subscriptions. Redirect these savings directly into your emergency fund. Also, consider ways to increase your income, such as freelancing, taking on a part-time job, or selling items you no longer need. Every extra dollar earned should be seen as potential emergency fund capital. Remember, the key to a successful savings plan is consistency. Even small amounts saved regularly can build up to a significant sum over time. Selecting the right tools to save and manage your emergency fund is as crucial as the fund itself. Opt for a high-yield savings account that offers better interest rates than a regular savings account. This ensures your money grows while it's saved. Look for accounts with no monthly fees, no minimum balance requirements, and easy access to funds. Online banks often offer competitive rates compared to traditional brick-and-mortar institutions. Additionally, consider using budgeting apps and financial management tools that can help you track your savings progress and keep you disciplined about your financial goals. Saving money consistently is not just a financial challenge, it's a psychological one. Understanding the mental barriers that prevent you from saving can help you overcome them. Common psychological hurdles include the temptation to spend now rather than save for later, feeling overwhelmed by financial goals, or underestimating the importance of small savings. To combat these, focus on the peace of mind and security that an emergency fund brings. Visualize the stress-free benefits of having financial backup. Moreover, treat saving as a non-negotiable expense in your budget, just like paying rent or a mortgage. Creating positive saving habits and understanding the psychological satisfaction of being financially prudent can significantly enhance your ability to build and maintain an emergency fund. Automation is a powerful tool in building your emergency fund. By setting up automatic transfers from your checking to your savings account, you can ensure that you save regularly without having to think about it each month. Decide on a specific amount that will automatically transfer on a set date each month, ideally right after you receive your paycheck. This pay-yourself-first approach ensures that saving for your emergency fund becomes a priority, not an afterthought. Automating your savings not only simplifies the process but also helps in building your fund consistently, making it less likely that you'll skip a month or divert funds elsewhere. Building a robust emergency fund might require some adjustments to your current lifestyle, particularly if your budget is tight. Evaluate your spending habits and identify areas where you can cut back. This might include dining out less, opting for less expensive entertainment options, or reducing impulse purchases. Consider adopting a minimalist approach to spending, focusing on what you truly need rather than what you want. This doesn't mean living frugally without any enjoyment, but rather making more mindful choices that align with your long-term financial goals. Remember, temporary sacrifices can lead to long-lasting financial security. Each dollar you save is a step closer to building a solid financial foundation that can withstand life's unexpected events. There are several myths surrounding emergency funds that can deter people from starting or maintaining one. Let's debunk a few myths. I don't earn enough to save for an emergency fund. Reality: everyone can save, no matter the income. It's about prioritizing your expenses and starting small. Myth: I can just use my credit card in an emergency. Reality: relying on credit cards can lead to high-interest debt. An emergency fund prevents this and keeps you financially stable. Myth: it's better to invest my money than keep it in a savings account. Reality: investments can fluctuate, and accessing funds quickly can be challenging. Emergency funds should be readily accessible and not subject to market risks. Understanding the truths behind these myths can help you make informed decisions about your emergency fund and ensure you are adequately prepared for any financial downturns. Once your emergency fund is established, it's crucial to maintain it. This means using it solely for emergencies and not for everyday expenses or impulse buys. Clearly define what constitutes an emergency. Typically, unexpected events that impact your ability to earn income or require immediate payment to resolve a crisis. After an emergency withdrawal, make it a priority to replenish the fund. Resume your regular savings contributions and adjust your budget if necessary to fill the fund back up to its original level. Regularly review your emergency fund as your financial situation changes. If your living expenses increase, for example, increase your emergency fund accordingly to ensure it remains adequate to cover your needs. Knowing when to use your emergency fund is as important as having one. It should only be used for significant, unexpected expenses that cannot be covered by your regular income. Examples include medical emergencies, urgent home repairs, or living expenses after a sudden job loss. Avoid using your emergency fund for planned expenses like vacations, weddings, or holiday shopping. For these costs, create a separate savings plan. By reserving your emergency fund for true emergencies, you ensure that the funds are there when you really need them, providing financial security and peace of mind during stressful times. If you need to use your emergency fund, focus on rebuilding it as soon as your financial situation stabilizes. Start by reviewing your budget and cutting non-essential expenses to free up more money for your emergency savings. Resume your automatic savings plan and consider increasing your contributions if possible to replenish the fund quicker. Stay committed to your savings goals and remember the security that having a fully funded emergency reserve brings. Rebuilding your emergency fund might take time, but with consistent effort and financial discipline, you can restore it and continue to protect yourself against future financial uncertainties. The benefits of maintaining an emergency fund extend beyond just financial security during unexpected events. It also contributes to your long-term financial health by preventing debt, supporting financial stability, and providing peace of mind. Having this fund also fosters a savings culture within families, teaching the value of financial preparedness and responsible money management. It can serve as a financial teaching tool for children, demonstrating the importance of saving and planning ahead. Furthermore, an emergency fund can be the foundation upon which you build other financial achievements, such as buying a home, investing for retirement, or starting a business. It's a crucial first step in any comprehensive financial plan. Learning from others can be incredibly motivating. Here are a few real-life examples of how emergency funds have helped individuals and families during critical times. Case Study 1. A family faced with a sudden job loss relied on their emergency fund to cover 3 months of living expenses, allowing them to focus on job hunting without the pressure of immediate financial ruin. Case Study 2. After an unexpected medical emergency, an individual was able to cover high medical costs, thanks to their well-funded emergency reserve. This prevented them from falling into medical debt, which is often crippling. These stories highlight the practical benefits and real-world applications of having an emergency fund. They demonstrate the peace of mind and financial control that comes from being prepared. Financial experts universally agree on the importance of emergency funds. Here's some expert advice to guide you. Dave Ramsey recommends starting with a $1,000 starter emergency fund, then building it to cover 3 to 6 months of expenses. Suze Orman stresses the importance of visibility and accessibility of your emergency fund. She recommends keeping it in a high-yield savings account where it can grow but remains accessible. These insights from financial gurus emphasize the universal principles of emergency preparedness in personal finance. They provide practical tips that can help you optimize your emergency savings. Building and maintaining an emergency fund is not without its challenges. Here are common hurdles and how to overcome them. Lack of motivation. Keep reminders of why you're saving. An emergency fund reduces stress and financial instability. Low income. Focus on cutting expenses and consider additional sources of income. Every little bit adds up. Irregular expenses. Track your spending meticulously to avoid surprises and adjust your budget regularly. By recognizing these challenges and proactively addressing them, you can enhance your ability to maintain a robust emergency fund. In conclusion, an emergency fund is not just a financial tool. It's a crucial element of a secure financial future. By understanding its importance, setting realistic goals, and systematically saving, you can build a financial safety net that protects you and your family from unexpected financial downturns. Remember, the goal of an emergency fund is to provide peace of mind and ensure that you have the resources to face life's challenges without financial despair. Start today and make building and maintaining your emergency fund a priority in your financial planning. Secure your financial future by preparing for the unexpected now. This comprehensive guide to building and maintaining an emergency fund highlights the foundational steps towards achieving financial stability and resilience. By following the outlined strategies and embracing a disciplined approach to savings, you ensure that when life does indeed happen, your financial well-being remains intact and secure.